dear learners of BBA and MBA programs and dear viewers. Good morning, and I welcome all of you to our today's presentation on the topic recognition and measurement concepts of accounting from your textbook Financial Accounting. You see in the screen the conceptual framework as per Financial Accounting Standard Board has 3 levels, and the level 3, that is recognition and measurement concepts of accounting, comprises assumptions, principles and constraints of accounting. At first, I discussed the assumptions in accounting concepts and beginning with monetary unit assumption. You know, in our country the monetary unit is taka. So, according to this assumption, only the transaction data that can be expressed in terms of money be included in the books of accounts, and this assumption helps accounting to quantify or measure the economic events, and this assumption is vital in applying the cost principle. You know, in an organization there are many events which are not recorded in the books of accounts, because the effects of these events cannot be translated objectively in money. The important events are resignation of manager from the organization, quality of the product or services, health of the owner, go slow policy of the workers, morale of the employees, etc. Suppose your official executives of your business has switched to another business and you have substantial loss, but it cannot be measured in money. So, it is not recorded in the books of account. Now, I discuss another assumption, that is economic entity assumption. Economic entity may be any organization or unit in society. It may be a business organization, it may be a municipality or city corporation, it may be any educational institution, it may be any governmental unit, or it may be any church, etc. And as per this assumption, a business is treated as separate entity or unit from its owners. In other words, the activities of the business entity are to be kept separate from the activities of the owner and all of other economic entities. And here the owner is treated as a creditor to the extent of his or her capital. Suppose Mr. Rohim invests taka 5 lakh into his business Messrs. Rohim Enterprise. So, this taka 5 lakh is the asset of the business as well as liability to the owner Mr. Rohim. Mr. Rohim, the owner of the Messrs. Rohim Enterprise, should keep the personal living expense or his personal expense from the expense of his business Messrs. Rohim Enterprise. Another example, if Mr. Rohim has 2 business entities, a petrol farm making a profit of taka 50,000 and another fast food shop sustaining a loss of taka 10,000. So, the accounts of both these organizations should be kept separate. Learners, now I discuss another important assumption, which is going concern assumption. This assumption is also known as continuity assumptions. The main theme of this assumption is that a business will continue in operation for an indefinite period of time, long, at least enough to carry out its existing plans and contracts. Simply to say, a business has a long life, it is not expected to be liquidated. The going concern is not applicable in case of liquidation only, like a project, because you know the starting and ending time of a project is known, whereas in organization the starting time is known, but the ending time is unknown. In absence of this assumption, the plant assets should be recorded at their liquidation value, not at cost price. The liquidation value is the excess of selling price over the cost of sales or disposal, and in that case the depreciation or amortization of these assets is not needed, and each period these assets are to be reported at their liquidation value. Also, without this assumption, the current and long term classification of assets and liabilities would not matter. That is, the classified balance sheet and income statement preparation becomes difficult. Learners, now we discuss another assumption, that is accounting period assumption. A few minutes back you came to know the life of the business is unlimited, and according to accounting period assumption, this unlimited life of the business is divided into a small chunk of time. It may be 1 year, it may be 3 months, 1 month or 6 months, normally 1 year for reporting to outsiders. And if this cannot be done, it would not be possible to know about the profit or loss and the position of assets or liabilities of the business until the business goes for liquidation. And the stakeholders like the owners, creditors, suppliers and other users, particularly the NBR, want to know the financial health of the organization at frequent duration. And for this purpose, the financial statements are prepared and provided by the company to the stakeholders. Dear learners and viewers, now we discuss the generally accepted accounting principles or GAAP, and before going to the discussion of GAAP, we have to know the meaning of principles. You know, principles are broad general laws or rules adopted as a guide to action. So, GAAP or generally accepted accounting principle means the broad rules adopted by accounting professions in identifying, recording and reporting of economic events. In other words, GAPs are a common set of standards that indicate how to record the economic events. For example, cost principle, revenue recognition principle, matching principle, full disclosure principle, etc. First of all, the cost principle, and this is very important principle. The main theme of this principle is that tangible fixed assets should be recorded at their cost, ignoring the market value. Cost is the exchange value or the financial sacrifice for acquiring something. Market value, on the other hand, is the value determined by the market for home at the time of sales. Suppose on January 1 you have purchased a land for your business for taka 10 lakh, and during January the value of the land increased to taka 11 lakh. According to this principle, on January 31st the value of the land should be reported at taka 10 lakh, even if the value of the land decreased to taka 9 lakh. At the time of acquisition, the cost and fair market value are same, but in subsequent periods the fair market value may vary, but the cost amount continues to be used in the accounting records. Learners, you may ask why the tangible fixed assets are recorded at cost. Because cost has an important advantage over other valuation. Cost is reliable and it can objectively measured and verified. Objectively means with supporting documents like invoices, vouchers, deed, etc. But some critics argue that cost is often not relevant and that fair market value often provide more useful information, and these principles ignore the qualitative aspects of things, and the inflationary changes is not adjusted in the financial statements, and due to these limitations in developed countries like Japan, America, the inflationary accounting system has been introduced. Learners, now we discuss another important principle, which is revenue recognition principle. Recognition means recording and reporting. So, revenue recognition principle means the laws or rules relating to recording of revenue in the accounting records and reporting it in the income statement. You know, revenues are gross increase in owner's equity resulting from the delivering of goods or services, and this principle is also known as realization principle. This principle emphasizes on the timing of recording revenue. As per this principle, revenue should be recognized when it is earned, and revenue is earned when goods are sold or services are provided. It may be in cash or on credit. Suppose you have sold 100 CDs to the customer at the price of taka 75 each and received cash of taka 5,000 out of taka 7,500. So, taka 2,500 still remains receivable. According to this principle, both the received and receivable amount are to be recognized in the books of accounts. Similarly, if the firm gets an order in the month of March to deliver goods in the month of May, the revenue will be earned in the month of May when the actual sales takes place. Learners, now discuss another principle, that is matching principle. This principle implies that the revenues and expenses of a particular accounting period should be matched. The period in which the revenues are earned and the expenses incurred to earn this revenue must be such to achieve the accurate income of the particular accounting period. So, expenses are expired cost or the sacrifice to earn the revenue. The unexpired cost should not be shown as expense, rather they are to be treated as assets. For example, for your business you have paid taka 60,000 as store rent, say it is from January to March and your accounting period is only January. So, at the end of the January you have to match or adjust or charge taka 20,000, that is rent of January as expense with the revenues of January to arrive at the profit of January. And if this taka 20,000 is not adjusted, then the expenses will be understated and the profit will be overstated. Now, we will discuss another principle, that is full disclosure principle. Full disclosure means the presentation of all relevant information relevant for user's decision. We know an organization finances from its owners and from outside sources. The stakeholders have the right to know about the necessary data and information with supporting footnotes and explanation. And the organization should provide the data and information in such a way that it becomes self-explanatory. In compliance with this principle, additional data, explanations, schedules, etc. are attached as supplementary information to the statements. Suppose your organization has a fixed asset of taka 5 million and taka 3 million is borrowed from a bank by the mortgage of this fixed asset. So, this information should be disclosed in the financial statements or as a note to the financial statement. Similarly, the accounting methods employed, for example, for charging depreciation, the changes in accounting methods and explanations regarding why these changes have been made, all this information should be disclosed properly. Learners, now we discuss the constraints of recognition and measurement concepts of accounting. Constraints are those limits or boundaries under which accounting functions or policies are restricted. At first, the cost benefit constraint. The main theme of this constraint is that the cost of obtaining information should not be more than that of the benefit derived from it. Suppose a business organization purchases some waste paper baskets which would be used for more than 1 year. However, the price of the basket is so negligible that the organization, though it will provide benefits or services for more than 1 year, charges it as expenses. The office supplies or stationeries like pen, pencil, eraser, etc. are to be recorded as expense, not asset. And the cost of recording these assets, for example, charging depreciation on user, is more costly than the benefit derived from it. Learners, now we discuss another constraint, that is materiality constraint. The term materiality means the relative importance and amount of an item or event in user's decision. An item is material if its inclusion or omission influence or change the judgment of a reasonable person, that is investor. So, the determination of what is material or what is immaterial depends upon the judgment of the reasonable person. So, in this case the precise criteria cannot be applied. Suppose the company A enjoys a profit of taka 10,000 from the sales of taka 1 lakh, whereas the company B enjoys a profit of taka 1,500 from the sales of taka 10,000. Apparently, it seems that the net profit amount in absolute amount of company A is more than that of company B, and it is more significant, but in terms of percentage, because the company A enjoys a profit of 10%, whereas company B makes profit 15% with regard to its sales. So, the net income figure of company B is more material. Learners, now we discuss another constraint, that is conservatism constraint, and this constraint is contrary to the full disclosure constraint, because under this constraint profit is understated than what the actual profit is, and it is often stated as anticipate no profit, but provide for all possible losses. According to this constraint, the ending inventory is valued at cost or market price, which one is lower. If the cost of ending inventory is taka 10,000 and market value is taka 12,000, according to this constraint the ending inventory should be valued at taka 10,000. No doubt there is a prospect of earning of taka 2,000, but this amount should not be recognized in the books of account. On the other hand, if the market price of the ending inventory is taka 8,000, then it should be valued at taka 8,000, though there is a chance for loss of taka 2,000. It indicates that the accountant should recognize all possible losses, but they should not anticipate the profit. Other examples of conservatism constraint are maintaining allowance for doubtful debts, using accelerated depreciation method for equipment and machinery, etc. Dear learners and viewers, we are about end of our today's program. I hope you have understood our today's presentation. However, if you have any problem or query regarding our today's presentation, you can consult your textbook or the concerned tutor. No more today. See you the next class. Till then, keep fine.